Stop getting denied for credit. Look, I get it. You're applying for stuff, you're getting denied, you're wondering what the heck is going on with my file. I thought that everything was squared away. I've been watching these videos. I thought I had it all dialed in. And so in this video today, I want to go through a couple of different things, a couple of models really that I want to give you to kind of think through that's going to help you increase your approvals, increase the amounts that you get, and also just have you live a better existence because it sucks when you think you have everything dialed in and you keep getting that big old red X saying, hey, thanks for your application. But swing back next time. We'll send you a letter in the mail in the meantime. And so the first place that I want to lead it off is your information is jacked up. Now, all right, Captain Obvious, I get it. And the reason why I wanted to start it off here, even though to you, you're probably like, yeah, dude, I get it. Like, this is so elementary, is because even though it's elementary, a lot of people want to skip over the basics because they think they're too advanced for the basics. And so fix this right away. Do yourself a favor and fix this right away because your personal and your business information, I'm going to speak to both of us today, right? Maybe you keep getting denied for personal credit cards. Maybe you keep getting denied for business credit, whatever it is. It's probably dated. And so I'll give you a real world example. We had a client that kept getting denied for something as simple as a business credit card. And lo and behold, on his personal credit profile, he still had his old employer on there, even though he was technically employed in his own business for the last 6 years. And so I said, dude, when's the last time you looked at your personal credit profile? Like, this is pretty important, especially if you're looking to scale you access to working capital. And he said, I hadn't even thought about it. I just thought that just having a good score was enough. And I said, well, that's the symptom. You have to go to the root cause. And so the root cause is the data that's being mined, that's being pulled into what comes out on the back end, which is the score. And so we had to go back in, readjust that across two of the bureaus that were reporting. I believe it was Experian and Equifax. TransUnion had it right. That's another thing. Some credit bureaus don't have, like, you can't just go off of, hey, one credit bureau has it, so the other ones surely must have it. You got to pull up all reports yourself. Go old school with it. Physically print out all the copies and start highlighting all the information that's incongruent on there between addresses, phone numbers, names, surnames, even sometimes, believe it or not, even your business's name is off. You can have, and this is a little bit more on the business side, but if you have something as simple as Irv LLC and it's really Irv Limited Liability Company physically spelled out, that right there is technically seen as incongruent information, incongruent content, and that can raise a red flag to the financial institutions and it just get the whole file thrown out with the bathwater. So again, your personal business or personal information is possibly dated, mismatching, flat out incorrect, or too many sources are negatively contributing. I want to hit on this last piece right here because you're probably wondering what exactly is too many sources. If you have, and this is, again, I'll use the example of the business side. If you have maybe business licenses that have maybe your name spelled a certain way, but then you go to the county record or you go to the DMV, they have your name a certain way, and maybe the junior is missing. And then you go to your maybe state record, and then the way that they have you as the owner on the entity has you without the junior, then that right there, you have too many sources that are negatively contributing. And so there's mismatching data. So the financial institution, the algorithms, what they do is they either end up denying essentially the application or the attempt for the application altogether, or they just put you on hold. They put like that pending, that yellow triangle that we dread to see, right? They put it on there and then they have you jump through a ton of hoops until your information is corrected. And so if you want to have it more of just a streamlined approach, then just go ahead and start here. Believe me when I say this is going to be a big lever that you can pull on. Make sure that all of your information is congruent. I'm going to give you some practical steps. Pull up your personal credit reports if this is just you for your personal credit, and obviously start running through everything that's listed on there and make sure that it's up to date. Over on the business side, pull up your business credit reports and do the same. Now, know the income types, for crying out loud, because this right here also ends up being a big red flag that I see a lot of people run into. But I want to help you out here because there are some different types of income sources or income types that you maybe aren't privy to, but I do want to give them to you here. There's a difference between household income, so HHI, and then sole income. So household income is going to be more for those of us. I typically tend to see it a little bit more with those of us who are married, we're filing jointly. On that, whenever it's asking you on the application, in that scenario, you can go ahead and put the total household income. And for crying out loud, especially if it's higher, that in this case, it's going to help you out because there's more people in the household, right? Now, the other side of this coin is sole income, which is what I guess most people think that they should be doing, but they're not seeing the full picture. And that's when you just put your income. Here's why you want to pay attention to this if you are married, is because if you, let's say you're making 90K and your spouse is making 90K, you guys can band that together. And now you're putting on the application 180 versus just 90. That's going to help you out, especially from a perspective of like a debt to income. That's going to help you out because there's more money that's going to be essentially floating, at least for the purpose of the total underwriting, right? Where they say, okay, there's 180, there's about 35K in expenses. There's enough money floating out versus 90, 35K in expenses. You've essentially wiped out over 30% of the person's income just off of that right there, right? For sole income, again, obviously, if you don't have a spouse or if it's just you, then of course, just go ahead and put sole income. That's just you. But I at least wanted to give you those two key differentiators because sometimes you'll have a partner, you'll have a spouse, and you guys can use both. Take advantage of that. Net income versus gross income. Gross is top line. That's how much the business brought in as a whole. And then net income is when you start factoring things like expenses. That's called your bottom line, right? So you have your gross income, you have your net income, you have projected revenues, and then you have year to date or current revenue. That's another one. This right here is more on the business side. So projected revenue, I see this a little bit more for startups because obviously you don't have financials to flex just yet. You don't have tax returns. So you're going to have to use projections, and that's totally fine. For your seasoned business owners, you can maybe use a YTD, so a year to date, or your current revenue. That's fine as well. Now, keep in mind, if you're maybe using that model a little bit more, some financial institutions, they may ask for things like bank statements. They may ask for current profit and loss. They may ask for financials, for your financial statements. So you have bank statements, financial statements, and then profit and loss. Sometimes they'll want a combination. Sometimes they'll just want one of the three. But just kind of keep that in mind. If you're going to be using current revenue, you want to be able to at least show that, especially if it's favorable and if it's on the up and up compared to maybe the same time last year. Next up, we got stated income and personal or P&L income, which we kind of just finished mentioning. Stated income is what you can actually show, and then the P&L, you can have your CPA draft that up for you, so that way they can kind of see, okay, where's your profit, where's your losses, and then you can start running numbers that way based off of, again, what you can actually show for, and not just a projection, because a projection is just like a hard shell. It's not true figures. Employment. So this is if you're employed. Here's like catch 22. If you are a startup, I'm going to give you two different scenarios. If you are a startup and you have a full-time job, then obviously you can go ahead and use your full-time job as employment income because you're still scaling your business. Actually, I'll give you three scenarios. What the heck? The second scenario is you are employed by your business, and obviously at that point, you would go ahead and put what your quote-unquote salary is on paper. And then the third scenario is for those of us that, you're thinking, dude, I don't have a business. It's just me. Then obviously at that point, you would just go ahead and put your employment income because at that point, it wouldn't be the business, and then it would be whatever you're getting on your W-2 or your 1099 if maybe you're a contractor. Self-employment, which we kind of just finished breaking down, that's going to be your 1099 income, and then investments. So if you have cash accounts, if you have stocks, if you have 401ks, like all of that, you can go ahead and kind of sum that up. For that, you can give a pretty good estimate. I always just say, hey, have it ready to go. So that way you're giving true figures. You wouldn't want to, at least I wouldn't recommend that you exaggerate that. So that way, if God forbid you put on there on accident cash accounts and stocks 90, and then all of a sudden you look, you say, oh, whoops, it was actually $25,000. When you go back, because sometimes banks do what's called a soft underwrite, they'll say, wait a minute, why was there a $75,000 liquidation? Like, what the heck happened? Okay, let's go ahead and bring some of this capital down. This is not looking good for this person. That's how they mitigate the risk. And so whenever you go to submit something, double check and triple check those numbers, because it would serve you better, in my experience of working with clients, if you actually started a little bit lower and then you started working up. Meaning, if you put on their cash accounts was 35, but wait a minute, I actually double checked it, and let me call the bank right now, because the cash accounts, or the funds that I have sitting in my accounts right now, are actually 70. And so you can work backwards from there, because obviously at that point they're not going to slash your limits for something like that. Wrong reasons for funding is another pitfall that I see of why people get denied, and I don't want you to be one of them. Here's some tripwire that you want to pay attention to. This is a question that you probably see on certain applications, especially on the personal loan side. Debt consolidation. Anytime I've ever seen that question get asked and people actually select debt consolidation, obviously be truthful, right, of what you're using it for. I just think that there's better options of what you can be using the funds for, that you could possibly be putting on there. Debt consolidation, paying down student loans, I've just seen those just scream high risk. I stay away from that. I personally, myself, whenever I've used a personal loan, I've used it and I've said, hey, I'm going to be making a big purchase. And that's just served me far better. For some of our real estate investors, they just select that they're going to be going into a real estate project. They're going to be doing some home renos. That serves them far better than debt consolidation. I mean, that right there, again, not telling you what to do, just based off of what we've seen. If it's worked for you, fantastic. I've seen it flop more often than not. Have your story straight and be mindful of what you say. Here's what I mean by that. I need credit if, for a business in case it goes out tomorrow, right? I need credit for our business. If not, then it goes out tomorrow. That right there, when you're speaking to a banker, and this is one of the things that I'm always training my clients on whenever they're going to be building out their business banking team, is have your story straight. Don't sound desperate, because this right here, again, screams a red flag. I know a lot of people get kind of caught up in, classification codes for the business. And yeah, there's a time and a place for it. But look, there's a second metric that's being graded, and that's the acumen and the character of the business owner, flat out. And so you can put everything on paper that you think is going to check the boxes. And the minute that they have you walk into a bank, they say, hey, let's have a word with you for a minute. What are you looking to do in this business? Well, if I don't get access to this capital, then I'm, going bankrupt tomorrow. Oh, good to know. Denied. Versus, so right now we are looking to expand, and again, being truthful about it, right? Right now we're looking to expand in our business, and I'm going to be using this working capital to deploy into some new markets that we plan on capturing. And so part of that is we're going to be picking up some more supplies. So I probably need about $30K for some new supplies that we're going to have based off of the numbers that I ran. And I plan on picking up 2 new contractors that I want to use some of this capital as well for payroll. Based off of how we've done some of these jobs, I'm projecting that we'll probably be able to clear about 125 on it based off of the numbers that I ran, and also similar projects that I've done in the past. Even though you know that if you don't get access to this capital, you're going out of business tomorrow. You see how different that sounds? And you see how more likely the business bankers are to actually hear you out and want to work with you and work with you if your file isn't there. Guys, we see this all the time with our clients when we're coaching them and we're talking to them on, hey, this is how you want to have everything set up. Hey, this is, how you want to articulate what you actually do in your business, because speech matters. The words that you use, the context of how you use them matters. So if you're using it to start a brand new business venture, this can also be a bit of a high risk. The only caveat here is if, number one, if you're not asking for an egregious amount, and number two is if maybe you're asking for like a business credit card. Other than that, you're not necessarily, going to run into any roadblocks. if you kind of play within those means. Again, for the purposes of using the funding for the wrong reasons. The next one is being misclassified. Now, there's two types of classifications that I want to talk about. One of them is going to be the industry classification. This is going to be how your business is bucketed for regulatory, tax, statistical. I want to add a fourth one here, and that's going to be and for banking reasons. And so an industry classification, simply put, is if you are in construction, the bank is going to give you a classification. Okay, this business is in construction. And then they're going to give you like a subcategory. And that's going to be, let's say they're in construction, but the subcategory is they do residential renovations. And that'll be what they would consider a subcategory. The reason why you want to pay attention to this is because this is, again, like I mentioned, how the banks and how the bureaus are going to bucket you. And then based off of where you're placed, that's how they're going to grade more so the threshold of how much lending they're either going to be able to give you, or if you fall outside of what they call their lending criteria, their lending appetite, their lending portfolio, that's when you start to land into denials altogether. The second type of classification is the misclassification between employees and independent contractors. You want to pay attention to this because on your business credit report, it's going to ask you how many employees you have. I've seen small business owners make the mistake of putting contractors as employees. They're not employees. They're contractors. They're paid on a 1099. An employee, number one, because of state regulations, is paid on a W-2. And there's also, again, some state regulations, and that varies by state, not to get too lost into this video. But that also varies by the regulations of the state, paid time off, how many hours they can actually work, do they need insurance, how much insurance coverage do they actually need, like that whole 9 yard. The kind of like the inverse of that is I've seen where you'll have a business owner has people on a W-2, and just because they think that, okay, it's just two assistants, or if, like, it's nothing crazy, I have two assistants, and then the guys that make the big bucks are like my contractors, right? No. You're still going to want to put the two, even if you think it's like a low level role, part-time job, like whatever it is. And I'm not talking bad about assistants. I'm just thinking of a recent file that we were working through. You still put that on there because that actually helps your business out in the long run when you're placing it on your business credit profile, because now you're building out the validity of the business. Because now it shows, okay, this person is involved in, said industry, and they have, let's say, these two employees, and they have this much cash flow left over. They have this much working capital that they need. They have these contractors. They have this many projects they're picking up. It all has to tell a story. So the classification is important. And then lastly is incongruency. That's a word, right? Incongruent numbers. Like I mentioned earlier, you're confusing gross figures with net figures. And so gross is top line. That's how much the business is bringing in before expenses. Net figures is after expenses. This is business 101, but I know that most people miss it. But hey, you're here. You're exaggerating your income and your revenue. Again, if I'm talking to you on the personal side, if you're exaggerating your income, be careful with that. If you're exaggerating your revenue, be careful with that. You shouldn't have to oversell your numbers just to get access to more capital. You want to play the game how it's intended to, and you want to play for it with longevity. Now, the other side of that coin is you're underestimating your income and your revenue levels. I'm going to give you a real world scenario here, and we'll close it out. When you underestimate your income or your revenue levels, and I'll kind of tie it in with when you exaggerate it, and this is more on the business side, the way that a business is classified, where business is located geographically, how long the business has been operating, that all puts you inside of a threshold. And so I'll give you just kind of like an example. If you right now are a business consultant, just a clear example, follow me here. A business consultant located in the middle of, let's say, Los Angeles, the amount of money that a business consultant, statistically based off of how they run their data in the census over in California, is going to vary wildly compared to a business consultant in the middle of Tennessee, right? In a small town in Tennessee. And so if you are, again, exaggerating your numbers based off of what you think the bank wants to see or what you think is, going to favor you, then you end up shooting yourself in the foot, because remember, they have data based off of thresholds. It's like, that's what I mentioned earlier. It's buckets. You're placed inside of a bucket. So this swings both ways on the business side or I should say on the projected side. So revenue, and then it also swings the other way on overestimating it and underestimating it is what I should say. And so when you're setting this up, if you're wondering, okay, Irv, like what's the practical way of doing this? I get what you mean, but what's the practical way? The practical way is you just flat out want to do your research. Given where you run business, given your line of work, what is the statistical average based off of the time that you've been in business? And again, if we're working off of projected revenue, if you have true totals, and use the true totals. If you have projected revenue, then you want to work off of what the statistics say based on your businesses. Hey, based on consulting firms inside of the middle of Tennessee, right? Insert city, insert small town. Let's say their first year in business, they're at 90K. I'm pretty optimistic. I think I'll be able to do at least 75K versus coming out the gate and putting $1 million. Hopefully you're kind of seeing the train of thought there, and you're kind of adopting that model, because that's going to serve you far better than just copying and pasting whatever you kind of see out there online. Because again, we see so many files that come in that we have to give a complete overhaul to in an audit, because they were just putting whatever they saw online, thinking that it was going to serve them, and it actually ended up hurting them. And now some of these people are having to work more to get out of that, to then land back to where they were going to be originally. So that is my TED Talk for today. I hope that you found this insightful. I know that this question kept coming up quite a bit, and so I wanted to give you as much context as I could, covering both types of people, right? Those of us on the personal side and those of us on the business side. If you found value in this, consider hitting that like button down below, because it does help spread the message to a larger group of people. If you are a small business owner who needs access to working capital and you're wondering if you're set up properly and you want to speak to a team of experts, look, we can take a look at that for you and see how we can potentially help you take this capital to the next level without obviously damaging your business along the way, because we want to make sure that we're helping business owners scale access to working capital in a predictable and sustainable way. If that's you, click the link down in the description or visit us at insideinnercircle.com. But other than that, I will see you in the next video. Bye.